Okay, thank you very much. Good morning, everyone. Lovely to see you all this morning on a call. It's a lovely, beautiful day in Joburg today, and I see it's raining, but in Cape Town. So this is our pre-close update. We go into our close period on the 1st of June. It's almost incredible to think that half of the year is nearly gone, and it feels like just yesterday when we presented our results, and quite recently we had our AGM that also had an operational update. So I think we've been given a fair amount of information on the first quarter already. So I'm going to try and just give you a sense as to where we are in April and what it looks like. So we really continue to try and stick with the fundamentals of property. Retail property is challenging, but there's also so much opportunity in it. And every day what we try to do is keep our malls occupied, because without good tenants and trading well, that we can't attract customers. And we make sure that we do whatever it takes to bring customers to our malls, and you'll see that our numbers are really starting to reflect that. Collecting rental is a really important focus, because that assists us in managing our business in the best possible way from a cash flow point of view. We track carefully how our tenants trade and where the turnover growth is coming from. And we continue to look at health and safety as a really important part of keeping an environment that's safe, so that people feel that they can come back to these malls. You've heard me many times talk about that it is really for us not about whether super regionals are better than neighborhood or community centers. It's really about the mall environment itself. And how do we make each and every one of our environments the best for the customer in that environment, so that we can get people in there and get their share of wallet and assist our tenants in that way. We're also providing in here our latest turnover data for April, and the occupancy rates as well. And in addition, we have started using a new customer behavior software, where we look at how our customers go around in our malls and understanding them a little bit better, so that we can give that shared value back to our tenants. I'll also talk a little bit about some of the leasing initiatives, and then just touch briefly on where we are with rent relief. So very encouraging that for the month of April, our foot count is actually at 101, almost 102% of what it was in 2019. So April 2020 was that month where we all stayed at home and where there were really nobody in our malls. So most of our metrics, we will track back to 2019 in 2021, because 2020 really does not give meaningful data. So it's really encouraging to see how in the earlier parts of towards the end of last year and the early parts of this year, we've seen 20% of customers just struggling to come back. And in April, we've really seen that we are back to where we were in 2019, and that is evident across our portfolio. As I said, we've implemented our customer counting software. So going forward and with our June results, we're going to give two sets of information. We're going to give the information in terms of foot count, what we've traditionally counted. So that is people that we count in the normal way, like we've always done. And we are now going to be in a position to actually track customers in a unique way. So we can then tell how many people are coming back and how many people are just once-offs. So we can actually start understanding what customer loyalty really looks like, where do people go in our malls, and use that information, one, to provide our tenants with richer data so that they can do what they need to do to attract more customers, and then also to remove pain points for customers. So we can start telling, do people queue too long to get into a lift? Do people take too long to pay at the parking stations? And how can we then improve all those type of things by this information that we have? We also use that to manage our operations a little bit better. So instead of sending a cleaner into our ablutions once every hour, we can do so after every 20th or 50th person, or however much you need to after clean that. So that all makes our business a lot more efficient. And we are really excited about being able to use this to manage our environments better. We see really also where customers go and what are their preferred things that they like to dwell at, and how do they move throughout the environment. And that is really important for us to understand. There's a question around dwell time, and I'll try and answer it as I go along. But I think what we are seeing overall is that customers, those that come more frequently, probably stay a little bit longer, so that because, you know, once there are queues, and I think that is a reality that we have to deal with, but people think about their shopping perhaps a little bit more carefully. So when they come, they stay a bit longer and they get everything that they need, so that they don't have to come that frequently. But I think as people become more comfortable with coming back, they will probably come a little bit more. And as the third wave moved in, they'll probably come a little bit less again. So we're a little bit, we need to be flexible in our thinking around that, and just continue to give them that safe environment where they feel they can come back to. Our retail turnover actually shows some great signs of recovery. We did report on this at our AGM, or in our operational update, that for the first quarter, at the end of last year, we saw turnovers recovering to just on over 90% of what it was in 2019. And in the first quarter in 2021, we're seeing that just under 4% down. What is more encouraging for us, though, is to look at what's happened in April. So we spoke about March, and we spoke about the fact that we've seen in Sandton that the March turnovers were up the highest in 5 years for the month of March. In April, we've seen a good encouraging trend continuing overall on our portfolio. The turnovers in April this year is up 2.3% from March. And then the turnover for April itself is only down around 6% if we can compare it to 2019, where March was down around 6.5% or 6.4%. So that just shows you this gradual improvement that we continue to see coming through. Our super regionals, as you know, were the most severe impacted, but they're also coming back really strong. So again, we've seen Sandton in April doing their best April in the last 5 years. And that is testament to the quality of everything that's going in that mall. And if we look at Sandton and Eastgate combined, we see the turnover being just over 4% down from 2019. So I think that strong performance from categories like technology, which were up around 30%, homeware and furniture up 1.2%. We didn't talk about luxury this time. We talk about it all the time. That's self-evident. You see this turnovers coming through and really see the encouraging signs. Of course, there are still tenants that experience challenges. We continue to engage with them. Jonathan and I are busy, and Jose is busy at the moment going through a conversation with all our large retailers, and we really go deep with them into what they are seeing, what we are seeing, and how can we collectively do the things that they want to achieve in our malls. And it's really been encouraging conversations with them as we've been through this process. In terms of hospitality, at the end of April, the Sandton Sun was the only hotel that was operational, and we opened the Garden Court, or one of the towers in the Garden Court, early in May. Sant & Sons occupancy rate in April was around 55%. In December, it was around 46%. And I think that you see people frequenting the hotel a lot more. There's obviously a little bit less local travel restrictions, but it still lacks international travel that hasn't come back. Sant & Sons doing particularly well. The Sand Deck is bringing good revenue for the hotel, and we are keeping the Interconti closed for now to minimize the cost, and that lease remains suspended whilst we don't have the hotel open. The convention center, we converted to a management agreement with Soho in 2020. And you would recall that the convention center was previously with Soho Gaming. It moved to Soho Hotels. It is now just on a fee basis. We're just trying to keep the cost as low as possible. It is still very much bound by restrictions, and there were a few, I think there were 5 events that took place between March and April, but until the restrictions are lifted, it will take some time before the convention center returns to normality. From an occupancy point of view, you know that for us it's very important to keep our occupancies at a good level. It's really not great. The cost of a vacancy is just so high that it is really better for us to make sure that we keep tenants trading, we keep them open, and we make sure that we continue to bring in new tenants that are interested in our portfolio, and we still have some of that. Our overall vacancy for our portfolio is now just short of 93%. Our retail occupancy remains really strong at 95%. And the office sector remains under pressure. I don't think there is anyone that's not feeling that pressure. We've seen a slight increase in the vacancies at Atrium and Fifth, but overall, it is still a small portion of our portfolio, and retail remains the majority of what we have. There's been good new letting that's taken place. We've spoken to the very exciting Adidas Halo concept store that will be opening in Sandton, and if you want to see what a Halo store looks like, go and look on the Mall of Dubai website. You'll see what their Halo store is like. It's really phenomenal. We've got Alexander McQueen opening in the Diamond Walk, as well as Chanel Cosmetics. We also got ARC Cosmetics that will open a Sephora-like store. And I think that highlights a few things. It highlights the strong demand for health and beauty, and also that there are brands that want to come into our portfolio. The vacancy figure for the office portfolio, someone is asking, is the occupancy is 87.6, so the vacancy is just over 12%. Is that right? 86.4. So yeah. 86.4, that makes it just over 13%. So Eastgate has also introduced a number of new tenants, including Armani Exchange, which is great for that portfolio. We have also renewed almost 20,000 square meters this year, and that's equally split between retail and office. Eastgate has introduced a new drive-in cinema on the roof, and Sandton City, as many of you would have seen, will also open their new drive-in next week. So it will be very interesting and exciting to go and see a movie on the roof there. We have also bringing some new tenants into Nelson Mandela Square. Lux City will open their new flagship store there, and many, you would have seen the big hype around the Tang restaurant opening in Nelson Mandela Square, and every day it's been full. It's very interesting to see people going in and out there. We have just recently moved into Nelson Mandela Square. Our offices are on the 3rd floor, just behind the statue. So we have a good view of the retail environment, and it's really great being there and experiencing our business in a different way. From a rental relief and collections point of view, the rental relief overall total are still within the 112 million that we disclosed in our year-end results. But at the end of April, almost 90% of those negotiations have been concluded, which is significantly up from where they were in December. It remains a focus for us, but we are working to conclude all those and get done with it. There are certain of the sectors that continue to require support, those being the restaurants until they can be fully occupied, and also theatres and gyms, as you know. The rental collections have continued to increase, and for the month of May, we collected 104% of our arrears. In April, that was 94%. The higher collections in May are as a result of the settlement of old balances where the negotiations were finalized and we could collect that money. In terms of liquidity, we remain well capitalized with an LTV of 23.6%, and we have unutilized RCF facilities of 247 million. We remain very focused on our response to COVID-19 and our commitment to building strong property fundamentals and just do the things that you do to keep a property operating in a responsible, sustainable manner. We've made good progress with our tenants, continue to engage with them on an ongoing basis, and that is coming through as we see their turnovers. That is continue to improve for them as we see the turnovers encouragingly recovering and as people coming back to the malls. We enter into a close period on the 1st of June, and we'll be presenting our results for the first half of the year on Monday, the 26th of July. I'll stop there and happy to take some questions.
Thank you, Amelia, for that informative update. Apologies all for the connectivity issues. Just a reminder to all attendees that you can submit your questions in the chat function located on the right-hand side, and I can read that to the management team. So in the meantime, I would like to kick off the Q&A. Great. So my first question to Amelia is, given recent accelerated trends such as e-commerce and working from home, are you comfortable with the current sector composition of retail, office, and specialized space in terms of the sustainability of the firm? Thanks.
Yeah, we are comfortable with what we have. We are a retail-focused business. Retail is what we are good at, and we believe that sticking to that knitting through the difficult times is what we have to continue to do. I think our operational results illustrate that our retail portfolio, because of the quality nature of it, is performing well, and that if we continue to do the things that we set out to do, these assets are the ones that stand the test of time. For us to now exit these good assets and go and buy something else, we don't think that is the right strategy for us, and we are happy with the portfolio that we have.
Thanks, Amelia. Let's go to the attendees' questions. So there's a question from Ridwan Lunat. He said, hi, can you give an approximate figure on rental relief provided year to date?
Well, ask Jose to deal with the financial numbers, please.
Morning, everyone. The rental relief for the first quarter of this year has largely been focused on the restaurants, the continued difficulty in the hospitality sector. So the hotel arrangements that we had last year continued. We're not sharing an exact figure for so far during the year. What we can say is that the provisions that we've made at the end of last year's figure in total was about 320 million across the entire Liberty portfolio, of which about 112 million related to L2D's share. For the negotiations that were ongoing at year end, we were at 70% complete and are now close on 90% complete with settling those offences. And we actually are within the provisions that we had for the last half of last year. So actually a bit of a saving on some of those discounts. This year's difficulties continue with some retailers, but our focus has primarily been to those in the restaurant and hospitality sectors, and it's still in line with where we expected it would be in the first quarter. So there hasn't been a significant blowout. More broadly than those categories, there are still retailers in difficulty, and we continue to monitor those. but it's still, we haven't seen a significant deterioration from year end last year. Thanks.
Thanks, Jose. This is another question from Jared Houston. He said, asking, what is your sense of current physical occupation in the greater Sandton office market?
I think it's still evident that there are a lot of the offices where people are not back yet, but it's certainly slowly improving. We have, Jonathan and I met last week with a mobility consultant that is working with the city of Johannesburg around the greater Sandton's road network and infrastructure. And the feedback from that was that the traffic is back to around 80% of capacity. Now, that doesn't necessarily mean that 80% of people are back at work, but I think it gives a good indication of how people have returned. It's not a 20% of capacity. It's difficult to tell exactly how many people are around in the offices, and you know, we tracked it. I think towards the end of the year we had it at around 40%, and it's probably between 60 and 80% would be my guess. But I thought that indication of the traffic count on capacity was a good indication of kind of where things are at the moment.
Thanks, Amelia. There's another question from Paulo de Almeida. He's asking, could you give us a further indications on retail reversions?
Retail reversions for this year, as we indicated in February, we budgeted for retail reversions to remain negative. And we have certainly seen that continue. However, it's not blown out as Jose also mentioned earlier. So, you know, it's as in our expectations. I mean, I think we have been saying even last year that we don't see reversions turning positive this year, except in specific cases. You know, a reversion in a retail space is very much focused around the turnover. So if you negotiate it with a tenant that's turnover is up 20%, you will not be getting a negative reversion. But there are negative reversions still. We'll still see it probably coming through for some time next year. And then, you know, after that, we should see it flatten out. The office, new leases for offices and leases for offices, though, have been really better than expectation, which has been very interesting. So people that choose to stay in offices, stay in the environments that they have, we have not seen such big negative reversions in that.
Thanks, Amelia. I think this sort of answers this another question, but I'll just ask it instead. Question from Sane Mamela. So what were the reversions on completed renewals in office and retail?
Yeah, as I said earlier, so the renewals were about split half of between these that we've concluded to date. So retail negative and some of our office reversions, but offices not, you know, offices remain a very small portion of our portfolio. So we haven't seen that negative reversions in the office space. Okay. We've also got smaller office tenants. We don't have exposure to huge office space per user. We have, you know, smaller spaces in our environments. Okay, thank you. Another question from Meisho Nene. Says, how have lease lengths changed in new lease negotiations, and have escalations been negotiated down? Lease lengths, you know, as well as escalations, are all a factor of the specific tenant that you're negotiating with. Of course, escalations in this low inflation environment have to come down. We can't have an environment where we have escalations at 8%. So we'll probably see escalations go to between around 6.5% is my overall sense. When we report on that, we'll get a better sense on that. Lease lengths, you have to negotiate that depending on where the tenant is. So I think a lot of lease tenure have been influenced by accounting conventions. So a lot of the large tenants now prefer 5-year leases because of the impact on the income statements. But 3-year leases in a time like this, where you're uncertain, for smaller tenants, probably easier to get get that over the line. And one of the things that we have been focusing on since the beginning of COVID and guided by our board is that in times of crisis, you have to just make slightly shorter term decisions because your view of the world is not that long that you can see that far in the future. So to keep things going, to keep the business going, and to keep tenancies in place, we create a lot more work for our leasing teams because they have to continue to do it over. But we are able to keep tenants in play by just keeping them a little bit of shorter duration and holding their hands through that process. And then, we'll do it again when the environment looks a little bit better and we can all look up and look forward.
Great, thanks. Another question from Kundai Munzara is asking, what initiatives do you have, if any, in generating non-GLA revenue streams across the platform?
Thanks, Kundai. We always have some additional initiatives to generate revenue. So we have our contract with our JC Deco that do the advertising in our malls, and of course that has been slightly impacted because I think marketing budgets for advertisers have been impacted, but there's still some interesting initiatives coming through. We've got a lot of court activations still continuing, and there are a lot of things happening in our malls that remain interesting. Things like the movies on the roof, those are non-GLA income. They sit in parking lots. Our hydroponic farm and aquaponics farm where we sell fish and vegetables, that's non-GLA income. So there's a lot of that in our environment overall.
Thanks, Amelia. There's another question from Paulo de Almeida. Is asking, where's LTV currently, and could you comment on valuation expectations? Thanks.
Thanks, yes. LTV is around 22% at the moment. It fluctuates a bit on our utilization of the RCF, but it's still quite conservative, even though we've written the portfolio down significantly at the end of last year. On valuations, I mean, as most of you are aware, we've written down our portfolio close on 17% during the course of 2020. We haven't necessarily seen that across the broader property market. In terms of our expectations of valuations going forward, specifically to our portfolio, a lot of our assumptions on where we think reversions are going to go, the escalation rates and renewals, etc., have been imputed into those valuations. Okay, and those, like we mentioned, are still in line with what our expectations are. So we don't expect a further significant impact on valuations from those, unless, of course, there are increased lockdowns again with this third wave now, and it impacts the retailers negatively. That'll have an impact that maybe we didn't expect. More broadly speaking, in our portfolio, we think the specific assets that remain under pressure are like Nelson Mandela Square because of the large component of restaurants in that asset specifically. Outside of that asset, the hotels, etc., are still under pressure given the occupancy rates and non-activity in those assets specifically. But we don't expect significant movement beyond that compared to where our valuations are at the moment. Yeah, thank you.
Thanks, Jose. Another question from Philip Niesing is asking, do you see the market considering alternative uses for the offices and also the retail space?
I think the market, they are always interested in doing things differently in times when the actual spaces of the actual use of the spaces are under stress. Our offices are small. All our offices are on our retail environment, so it's not, we don't have offices where we can take the entire building and turn them into a residential space because our offices don't lead it to that. Of course, there are things like, some education facilities, etc., that continue to look into the offices in some form or fashion. Retail, we have for a long time been doing things different in some of our retail spaces. Bringing some alternate uses into it, but are we going to change retail spaces into living spaces? Probably not. our retail remains good prime retail. We've done some of the things that are to be done. So, we've changed when we did the checkers reconfiguration in Sandton, we put some storage underneath in Sandton there, and it really works exceptionally well. We are bringing motor showroom into the parking at Sandton, so those environments will start being part of the retail. And there are already doctors in some of our spaces, and there are a lot of additional uses that we continue to consider, but our retail space is still prime, and it is the notion of having those really big showcases for the retailers in our environments, and having they want to have the benefit of online and the physical retail space, and use that as the showcase for what they have.
Thanks, Amelia. There's another question from Nazim Samsudin. He's asking, what is the proportion of pop-up stores in the retail portfolio, and how do these leases work? And has there been growth in these types of product across your portfolio?
Thanks, Nazim. Yeah, pop-up stores really comes as a result of a few different things. So a pop-up store will normally come when a tenant is waiting to move into a space and the space is not quite available, so they would put a pop-up store in, or in between renovations of the current stores, they would put some of that in. And then in some cases where they just want to try out a concept and try see how that works. So those leases also, we are flexible with that. We would have some of them for longer periods, some of them for shorter periods. The problem with a pop-up store is that they don't fit out properly, and our fit outs are important for us because it impacts on the customer experience. And if you have a place full of pop-up stores, you just get fit out that don't really look great. I mean, if you walk down the mall passage, you can immediately see what is a pop-up, because their fit outs are not at the quality that we want them to be. But the team used that to try new things, to experiment, to bring new concepts in. And I wouldn't say that is something that all of a sudden is taking over our portfolio. And we continue to focus on core leasing and get the right tenants in place so that we can get the right mix of tenants in there. But of course, pop-ups is a tool that we can use to move things around, try new things out, and create some variety in our portfolio.
Thanks, Amelia. Another question from Philip Niesing. He's asking, what is your exposure to Ster-Kinekor?
We have our exposure to Ster-Kinekor from a space point of view is fairly low. And we have the movies at Sandton and Eastgate, and then at Promenade. And as we said previously, we would be keen to take the Promenade movies back because we can unlock that space. Sandton and Eastgate, we are working with Ster-Kinekor to come up with a plan and finding a way to provide that experience to customers. But I think overall, from a Ster-Kinekor point of view, there are probably too many screens, too many theatres across the board. But both Sandton and Eastgate are good movie houses, and they continue to attract customers. And we have to work with them to see where we get to with this as part of their business rescue process.
Thanks for that, Amelia. Another question from Mahir Abdulali. He's asking, can you please provide an indication of where property valuations could settle at June? How do the outcomes with respect to reversions, vacancies, etc., compare to the valuation assumptions? And a third question is, what would you consider to be the key property valuation risk going forward?
Yes, thanks. As I noted earlier, the valuations assumptions that we had at year-end regarding reversions and where we thought our renewals will settle, our vacancies are all imputed into the year-end valuations. We don't expect a significant movement for mid-year. There are specific assets that have issues, specifically Nelson Mandela Square, given the large component of restaurants in that asset, and the hotels remain under pressure. Outside of those, we don't expect significant movement. what will impact valuations or place valuations under threat going forward. I think municipal and utility costs remain a threat to every property in the country. It still is outstripping growth in income by a large mile. I think what we'll see over the next while as well is that insurance costs for physical property is going to increase, given where the insurance sector is, and I guess a lesser appetite for risk and a higher premium being paid for assuming risk. And those are two things I think will impact forward. Outside of the difficulty that retailers face that maybe in a year or two ago wasn't such big threats. Thanks.
Thanks, Jose. Another question from Anton de Goede. He's asking, what was Botshabelo impacted by the recent shutdown protests in Bloemfontein?
Anton, I think Botshabelo is like the little Sandton there in the south of the Free State. Botshabelo is really continuing to fly, and it's trading very well, and it didn't have a shutdown recently through what's happened in Bloemfontein.
Thanks, Amelia. A question from Ridwan Lunat. He's asking, are there any major tenants that are of concern, such as the likes of Game, etc.? And what are the types of discussions you are having with them?
We are having these discussions with all the national tenants one-on-one in a lot of detail at the moment. We've recently met with Massmart, and we don't have any risk with them at the moment. In fact, there are some of the other brands that they are looking at bringing into our malls. So I think, you know, the big renewals that needed to take place have taken place. And we don't have a concern that we will lose them out of any of our malls at the moment.
Thanks, Amelia. Question from Keelan Lovu. He's asking, have you seen an improvement in regional tourists from the continent, specific to trading at Diamond Walk, Sandton City, Nelson Mandela Square, restaurants and hotels?
I think, Keelan, we certainly, if you go to Sandton Sun, you will notice that where in the past you would have seen kind of a balance almost towards regional tourists in that environment, you see a lot of local people there, and the hotel certainly has that experience that most of the customers are locals. If we talk to our tenants in the Diamond Walk, asking them where do their sales come from, they'll certainly talk about the local customer being the one that's been holding them up for the last year. I think there's certainly been an increase in the tourists coming from the continent, and some of the restaurants at Nelson Mandela Square is where you specifically can start noticing that. But it's not something that we've seen previously, where there's a lot of that. I think the local market has really been very, very loyal and supportive to our environments, and we'll continue to track that and see where it goes. And hopefully, when the borders open and when more people can come, we should see an improvement in that.
Thanks, Amelia. Just a reminder to attendees, you can ask your questions in the chat function located on the right-hand side. So there's another question from Nessie Chetty is asking, can you provide an update on the appeals relating to the Liberty Promenade market value and Sandton City market value appeals as well? And also, where are we in the process?
Thanks, Yes. The Promenade valuation appeal has been settled with the City of Cape Town in our favor. There was a marginal difference to what our expectation was, but largely in our favor compared to where the appeal started. The Sandton City valuation appeal has been 3 days of hearings late last month, and the next dates have been set, I think, for early July. So arguments have been presented to the Valuation Appeals Board, and we'll hope to have that concluded early July. Thanks.
Thanks, Jose. Another question from Kirsten Govinsamy. He's asking, please could you comment on the trading activity at Eastgate Mall?
So Eastgate, as I said in my update earlier, Eastgate have been more severely impacted than what we've seen at Sandton. It is a customer that are more value orientated, and part of the work that we've done at Eastgate is to bring more of those value brands into that environment, because that we've seen that really doing well. And we spoke in February about Value Co, the tenant that we are opening a large store there and resolving the vacancy that we had in the house and home area. And I think that will assist the trading activity at Eastgate. Yesterday, we actually had the team present to us and we heard, for example, the numbers for Ster-Kinekor, which I thought were encouraging at Eastgate. And we see some good green shoots coming through and continue to track that and making sure that we put into this mall tenants that talk to the clients that are there. And yeah, I think we, certainly not trading at the levels where Sandton is trading, but just edging forward all the time to bring the customers or the tenants and customers together in a way that works for them.
Great, thank you. Another question from Mahir Hamdullah. He's asking, based on the preliminary evidence, have the ex-Edcon stores traded in line with expectations? And the second part of the question, are you comfortable regarding the rental sustainability of Edgar's in particular?
This week we met with Retailability and had a chat with Norman, and I was certainly encouraged by how comfortable they were with where they've been. They felt that they will be getting to their expectations in terms of the stores in this year. I think they had a lot of learnings that they had to take care of in the last year, and maybe things that they thought were happened all didn't happen in the right way. We, as we said previously, continue to work with them to take some space back at Sandton, because we think that is important to make that store a little bit smaller. We've done that already at Eastgate, as you know. And in his own words, Promenade and Midlands Mall are trading absolutely fine for them. So the rentals that we negotiated with them, we are comfortable with that at this point, and I'm certainly comfortable with them as in trading to their own expectations after the meeting we had with them this week.
Thanks, Amelia. Just a reminder to attendees, please could you add your questions on the right-hand side of the Q&A chat function. A few questions from me. So it goes, do you expect rental relief in terms of discounts and deferrals to increase, and by how much, given the third wave is approaching in South Africa?
Yeah, yes, it's hard to say. If government places restrictions on trading activity, then that'll have an impact. We don't expect an increase certainly over last year. We do expect certain categories of tenants to remain under pressure, and we intend to help them. And we've mentioned what those are: the restaurants and hospitality sector largely. And the others, we talk to the tenants more regularly than I think ever in our history. And we continue to help where we can. Some are in more trouble than others. And we look at the sustainability of their operations and whether they still fit within the space that we have for them in the portfolio in our decision making. Obviously, the environments need to be kept relevant, and we look at keeping the tenant in operation as far as we can. Thanks.
Thanks, Jose. There's a question from Aloy Kheng. She's asking, with the third wave coming, what are the measures that you've put in place to ensure that there's no loss of revenue from your side?
I think it's impossible to making sure that there's no loss of revenue with the third wave that are uncertain, and that we don't know what the government is going to do. And what we have is an environment that is safe. We have tenants that are supported, and we'll make sure that we keep customers safe as they come in. And we'll have to go through this like we've been through the second wave and the first, well, not the first wave, but the second wave. Certainly, we've seen some impact. I think everyone will see some impact. It's we can't not have any impact, but we'll do the best we can every day in the best possible way. Yes, I just want to correct my statement on the Botshabelo issue to Anton earlier. in that on the day of those protests, we made the trade voluntary at Botshabelo Mall, and there was some closure for a day in about a small portion of the space. So apologies for that, Anton, just a correction on that.
Thanks, Amelia. Another question from me. Could you please provide some thoughts on potential reclassification of retail or parking space to such or to alternatives? So, for example, retail parking to maybe storage or storerooms.
So parking is a tricky thing to manage, because we also have got some parking. You know, you need to have a certain number of parking bays for per 100 square meters, and we certainly not have any intention to not comply to that until we go for a relaxation. So, you know, in some cases we might well go for a relaxation because it's not necessary to have those parking bays. Where we have converted space, they will be like the storage space at Sandton. We convert, I mean, the Checkers loading areas, we converted into storage space. We would be doing that. In the parking space where we do take up parking bays, for example, at Sandton, where we do the motor showroom, I mean, it's not an enormous amount of bays, and we would normally have some excess bays, so we won't have to you know, do some new parking. So I think those are small changes that we will undertake. It's not big changes, and if there is a big activity that needs to take place and we need to replace parking bays, then we will do so or go for the relaxation.
Thanks, Amelia. There's a question from Jared Houston asking, are pricing expectations from for acquisition opportunities starting to become more realistic?
Yes, we haven't seen any evidence of that in the discussions that we've had over the last. With that being said, our focus is not on buying single asset opportunities anymore. Maybe 2 or 3 years ago, we were considering that. I think for us, a larger corporate transaction in the medium to longer term is probably what we should be targeting to unlock most value out of our business. And that is what our focus has been on. Thanks.
Thanks, Jose. Just a last question from me. Have you had any international interest from investors on your flagship assets? If you could get any comments or thoughts on that. Thanks.
No, not from international investors. We haven't had any interest of late. I think everyone is focused on, I guess, just surviving rather than expanding significantly. In our own portfolio, I think some of the initiatives that property companies will focus on is cost. You know, how can you be more efficient with the assets that you've got? And I wanted to add to what Amelia said earlier. I mean, if there is another wave of lockdowns, we've become very adept at how you respond to these things at very short notice. We have seen some cost savings in the operational costs of these assets during the lockdown periods. Now, you can never save yourself rich, but you certainly need to be able to squeeze the value where you can in our portfolio. And that has been the focus of our teams, in addition to all the other things that they're doing, is looking at our cost base and finding areas that we can squeeze value out of the portfolio. And there certainly has been some progress in that regard. Thank you.
Thanks, Jose, for that answer. There seems to be no more questions on the Q&A function, and I've asked my questions. So I think on that we can, and we are almost out of time. So Amelia, would you like to share some parting words before we close the call?
Thank you very much, Mikesh, for hosting us. Thank you for everyone's questions. And yeah, as Jose said, you know, we've become adept to just whatever comes our way, we have to manage it. You know, it's a challenging environment at the moment. We remain very realistic about the challenges that we have. We also believe that that's what we are here for. We are here to find solutions, to move forward every day, and to hold hands with our tenants and to do the best that we can. Our focus is really on operationally creating a business as strong as we possibly can, keep the quality of our assets, keep them occupied, and bring people in to be in these environments in a safe and responsible manner. So we are going to be in our close period now, and we'll chat to you again when we release our half-year results.
Thanks, Amelia and Jose. And with that, I think we can close the call. Thank you, everyone, for attending, and enjoy the rest of your day and weekend.
Thank you very much.
Thanks. Bye.
Yes, bye.